Hello and welcome back, guys. So, in this particular session, we'll be looking at Jocatt. So, it's from SPR exam kit, question number 4. Okay. So, what we are given is that I'll show you the questions quickly. So, what we are given is that shit, man, where did the picture go? Okay. So, what we've been given is that we've been given SOFP, SOPL as well, and then after that we've been given statement of changes in equity. So let's read few of them. Let's go one by one. Okay. So the following draft group financial statements relate to Jocatt, a public limited company with a reporting date of 30th November 20x2. Extracts from SOFP as at 30th November. PPE investment property is also there. Okay. There has been a change, gain of 2. Remember that, because that will be added in when you're calculating your PBT, right? So goodwill as well, it's 40, 68, 40. So what has been the change? Acquisition, disposals or impairment, we need to calculate that. Financial asset, let's look at that as well, because what kind of financial asset, that depends as well, because if it is equity measured through fair value through OCI, then it is basically credited to OCI if there has been any gains or not. So we'll have to look at that as well. Okay. So current assets, inventory, trade receivables. This will be important because when we are calculating working capital. So long-term borrowing has been changed. Financing activities, deferred tax, there has been change. So defined benefit pension, defined benefit pension deficit. Okay, pension deficit has increased. Trade payables, current tax payables, and then SOPL is profit from operations is 52, finance cost is 8, and then after that profit before tax is 44, tax expense is 11. Okay, so we do have PPE revaluation of 4, and then net measurement gain on defined benefit plan 8 is also there, and then tax on above is also there. Okay, so let's look at this as well. So important thing to look out for is dividend. There has been a dividend payout. Okay, 5 million. There has been a dividend payment of 5. NCI case is 11. Okay, and then a revaluation reserves has decreased by 5 million. Okay, we'll look at that as well. So the following information relates to the financial statements of Jocatt on 1st December 20x1, which means exactly 1 year before, right? Acquired 8% of the ordinary shares of Tigret for 4 million and recorded it as a financial asset at the cost of purchase. So 4 million, remember we had a 4 million financial asset, that means it is of that. Okay, where is it, this financial asset? So it is equity investment, right? So equity is always, what do we do with equity? If it is carried through OCI, then even it says over here it's designated as fair value through OCI, so that will be irrecoverable choice. Okay, so once it has been classified as fair value through OCI, it cannot be brought again changed back to a fair value through profit or loss. Okay, so any gains or losses should be taken into OCI, and then after that, having said that, so what are the items of OCI? It just basically means that the business model is to hold that particular asset for a longer period of time. Okay, on 30th June, right? So after how many months? So December, January, February, March, April, May, June, right? Whole of June. That means 7 month. December, January, February, March, April, May, June. Yep, 7 month. Acquired 52%. So 52 plus 80. Now it's 60. The purchase consideration comprised on 30th June of 15 million cash, shares of 15 million, right? The fair value of non-controlling interest on 30th June was determined to be this value. The fair value of identifiable net assets at acquisition date, excluding deferred tax, was 45 million, as was and included trade receivables and payables. Okay, Jocatt has calculated and accounted for goodwill arising on the acquisition of take rate of 5 million, which is, what did you do? 30. So just added this plus 20 minus 45. Okay, so we need to look. However, the following has not been taken into account. Okay, so we need to explain that as well. Well, when they are calculating the goodwill. So at 30th June 20x2, the fair value of 8% holding has risen to 1 million. Remember, it was 4, 1 is increased, right? So we need to increase it as well. So that will increase our goodwill as well. Okay, always remember that. So the 1 million gain will be credited, and then after that, the investment is still classified as financial asset and is measured at 4 million. Okay, so this should be de-recognized as a financial asset because now it is a subsidiary. The tax base of net identifiable assets was 35 million. So we'll look at the difference between net assets and then figure it out. Okay, tax rate is also there, and then goodwill relating to all subsidiaries had been impaired and tested in the year 30th November 20x2, and any impairment correctly calculated and accounted for. Operates a defined benefit scheme. The service cost component for the year ended is 6. Net component is 2 million is included within finance cost. It's already included within that. This is fair value model for measuring investment property. No investment properties has been purchased or sold in the current period. Jocatt sold PPE with a carrying amount of 10 million for cash of 19. Depreciation for the period was this much. Okay, so first thing first, what we will do is that, so let's read the discuss with calculation how goodwill arising on the acquisition of TZ should be calculated. So the adjustment needed to be made to consolidated financial statement, right? So first thing first, A1. So let's use our standard format. Not bubble. Let's create a new spreadsheet. rent NCI, right? So this what will be in percentage. So this is 8 plus 52, right? And then this is 60% and then 40%, right? And then working note to calculation of net assets of subsidiary reporting. I mean, at acquisition, at reporting, post acquisition. So we are not given over here, but we've been given over here, right? Okay, net assets was excluding deferred tax was 45 million, and then it included this item as well, receivables and payables. So it should include this too as well, because that is also part of net assets, right? So it's 45 straightforward, right? And then we don't need anything of reporting and post acquisition because we are only calculating goodwill. So working note 3. This is also called step acquisition, okay guys? Calculation of goodwill, hold, and then fair value of previous interest, fair value of additional interest, and then fair value of NCI, okay? Less net assets at acquisition. This is this figure minus this figure, okay? So what's our previously held interest? Previously held interest is, so it has risen to 5 million, right? So it's 5 million, okay? 5 million. And then after that, what's the additional interest? Additional interest is how much did we pay then? Over here, cash and shares, 15, right? So is equals to 15 plus 15, 30, right? and then NCI 20, and then there is another thing that we need to consider: deferred tax. Okay, so where is deferred tax? So deferred tax will be, so our tax base is 35 and then our net assets is 45, right? So there will be a tax on additional 45 minus 35, so it will be deferred tax 35 minus 35 into 30%, right? 30%, okay. This will be the deferred tax. So our goodwill will be sum of everything, right? 13, okay. And then after that, what should we basically say in case of goodwill? Goodwill is the difference between the cost of investment total cost of investment and fair value of non-controlling interest and net assets at acquisition. In this particular case, Jocatt was acquired in stages, also known as step acquisition, right? And then after that, on the date on the date on 30 June, right? 30 June 0x2 to 0x2 when control is acquired in the previously held interest is revalued to fair value and any gains or losses credited to SOPL. When control is acquired in stages, so 5 million, right? The fair value in the 8% holding, the 8% holding in Jocatt is revalued to its fair value, that is $5 million. So a gain of $1 million. Million is credited to SOPL. Entry would be debit and goodwill, 5 million, and then credit financial asset. Because we have a financial asset now, it needs to be derecognized, right? So $4 million, 4 million financial asset, 4 million, and then credit PL, right? $1 million. And then where is the other three? So now it's moved on to 10 million, right? So the goodwill has a balance of 10 million. So we need to talk about the deferred tax assets thing as well, okay? The identifiable net assets of Jocatt at acquisition date, okay? Acquisition are consolidated at their fair value of $45 million, okay? acquisition integrate is not there. Anyways, so now what we normally do is that, so what this basically means is that, so the when we are acquiring any assets, right, so the assets is fair valued, right. I mean, you are valuing it at a fair value, right, so it might be greater than the carrying amount, right, so that might create a deferred tax liability, right, so there might be a gain, right. So what we will do is that, the identifiable net assets of Tigrid at acquisition are consolidated at their fair value of 45 million, whereas the carrying amount of the net assets as per tax base is only $35 million, right? Thus, it creates a taxable difference of $10 million, right? 10 million, and a deferred tax liability of $3 million, right? Because $10 into 30%. All right. So what we will do is that this will be treated as a part of subsidiaries net assets. Okay. This will be treated as a part of subsidiaries acquisition of net assets. So will also increase by 3 million. Okay, so the entry being debit goodwill, obviously if that's increasing, then credit deferred tax liability, right. So all you need to remember is that sometimes this sort of question we have not looked into. So this is the first question I think in SPR as well, of this kind of sort, okay, of this kind of thing. So basically, the carrying amount is less, and which is as per tax base is only 35, whereas the fair value is 45 million. So because when we are acquiring any subsidiary, we value that assets at fair value, right? So the valuation might be higher than the carrying amount, so that creates a taxable difference, and then in this case it has created a taxable difference of 10 million. So 10 million is our taxable difference, whereas the percentage of it is, tax percentage is 30%. Okay, so that will be our deferred tax liability. So it's not a liability right now because we won't be selling it right now straight away, right? That's why it's a deferred tax liability. Okay, so when we sell it later on, suppose if we sell the subsidiary, let's say tomorrow, then we have to pay this tax liability then only. Okay, so this will be treated as part of subsidiary's acquisition of net assets. Okay, so it should be treated as a part of subsidiary's net assets. Anything else that we need to explain? I don't think so. So what we'll do is that let's copy and paste this whole thing. Copy, paste unlinked. And then what we've been asked in question number B is that, so question number 2, I mean, not B. So I next. So we need to prepare cash flow from operating activities and cash flow from financing activities, right? Using indirect method. So it has particularly said that as well. Cash flow, right? Okay, let's do it. Cash flow from operating activities. So that means all the way down to tax paid, right? Operating activities. So what's our profit before tax? Profit before tax. I think I will do it in Excel. That will be better, right? Rather than doing it over here. We'll just copy paste everything. Profit before tax. Okay, so I'll just put the figures in this column. Profit before tax, PBT. PBT is 44. 44. First thing first, so there was something about finance cost right down here. There was something about finance cost, so it included in that finance cost, right? So that means we don't need to worry about that. So finance cost 8 million, right? So this is dollar million. And then after that, service component, let's write that down as well. Component, service cost component is 16, right? Depreciation, there is depreciation as well, right? Over here, down over here somewhere, 27. Depreciation, this is all non-cash item. Depreciation being 26, 27, 27, right? After that, so let's look at few more things. So let's look at goodwill, and then we will look at PPE as well, okay? And then this thing as well. Or what we could do is that we could do that first of all. So investment property. What the hell? So it was 68 down to 40, right? So why has it decreased? Okay. No, that's goodwill. Investment property is over here 6 and then 8, right? So gain, right? So gain on investment property. What I'll do is that I'll quickly create a working side by side. So working note 1, bold, investment property, right? In this case, what has happened? Opening balance and then closing balance. So opening balance was 6, 8, right? 6, 8. That means the gain of this minus this. Balancing figure. Working note 1, right? And then after that, working note 2. So let's do about goodwill. Let's finish it off as well. Particulars. I like to do it this way. This amount. So opening goodwill. Opening balance. So this is from this 68, 68, and then closing is 40. 68, okay. So addition, purchase, addition. Alright, so addition is 13 from here. This was the addition. Did we sell anything on this? I don't think so. So our total being right. Bold it. So by closing, so there should be same figure over here as well. 81. And then our closing balance is 40, right? So that means there has been an impairment of this minus this 40. Our goodwill, where did it go? So 40, right? So so this goodwill figure does not include the 8. Okay, So why we are getting higher impairment is that, remember, when they were doing it, so remember, like when the question was doing it, they only had 5 million as a goodwill, right? So we need to increase that by 8 million more, okay? Because our goodwill is 13 million. So that means this figure does not include the 8 because it only includes the 5, right? So we need to increase it by 8 plus 8, okay? So now we get our impairment by impairment, okay? So what we will do is that bring that figure down over here. Impairment goodwill, working note 2, right? So this is no way. So again we added it over there. So that means it's added on that figure, right? So we need to reduce it from here. And then impairment has already been reduced, so it should be added, right? And then after that, what have we got? What has happened next is this thing has already been accounted for. The finance cost is already included. 2 million is already included within the 8 million or something of that sort. 8 million, right? So that's already been included in that. So it's 6 plus 2. That means that figure was already reduced from that PBT. So we added it back. We added the whole amount back. So that should not make a difference. So what we need to recognize more is that, so this thing is done, this thing is done as well, and then this property. Okay, so first thing, another thing, SOPL, we need to reduce this figure as well. Gain on 8% interest revaluation. Okay, so this is -1. All right. Anything else that we've done? Okay, sold PP with a carrying amount of 10 million for 19 million. So there has been a gain of 9 million, right? So that should be reduced as well. Gain on sale of PP is 19 minus 10. So minus 19 plus 10, okay? It should be -9. Right, anything else that we are missing? I think we've completed everything. So what about changes in working capital? No. First thing, how much did we pay for them? Defined benefit obligation. How much did we pay? That is also a cash out, right? How much did we pay? So pension benefit. So we need to create a reconciliation. Okay, let's do that. Working note 3. Hmm, net defined obligation at beginning. Then after that net interest. Then after that service cost. Then after that what do we do? Contribution into plan. Benefits paid. And then from here we get a subtotal. Then remeasurement component. And then net defined obligation at end, right? And so let's put the figures in. So it was 22 increased to 25, 22 increased to 25, 22 increased to 25, right? And then our service cost component is 16, right? Net interest component is 2, I guess. 2 million. And then what about our remeasurement? The remeasurement is over here, should be over here. Net remeasurement gain 8. 2, and then this should be minus 8. Okay, so this figure should be this plus this 17. That means what was the contribution into the plan? It was speed this figure plus this figure plus this figure minus this figure, right? This should be the balancing figure. What has gone wrong over here? How much should this be? This will be 16 plus 22 plus this figure, right? So 14. 40. Okay, so I got it. So it should be this plus this minus this minus this plus this. That's where I made mistake. I should have done this plus this. Alright, and then after that, no. So 40 minus 7. It should be 40 minus 7, right? 733. So I should have added it up. That's where I missed. So it's minus 7. Okay, so remeasurement component. So our contribution into the plan is minus 7, right? So this figure, contribution into the plan. Right. Anything else? Changes in working capital after that? Let's move on. Changes in working capital. Okay, so let's not miss this. Working note 3. So I'll just bold it. What has happened to our inventory? So inventory and trade receivable, decrease in inventory and decrease, right? So decrease in inventory, decrease in receivables, right? So this figure will be small figure minus the bigger figure. So 105 minus 128. 105 minus 128. No inventory revaluation, I guess. Nope. That's 128 minus 105 because inventory has decreased. That means cash has come into the business. So receivables has decreased. 113 minus 62. 113 minus 62, right? Anything else? Yep, there is something else. Remember, we have a receivable over here as well. So which is already included, right? So that is already included. So that means, so where is it already included? It's already included in, no, it's not included in this figure. That's why we need to add it up. And that will give us the net change, right? Because at this period it was not, it has not been recorded. So that means 113 minus 63 60, how much is it? 63, 62. 62 minus 5, right? 62 minus, nope, because that's not included within this figure, so plus 5. This is how we get our inventory, right? So what has happened to our payables? Trade payables, so it has increasing payables, right? So same thing over here as well. What we need to do is that, so this figure does not include the other figure from the behind, so 55 plus. So since it has increased, that means what we can do is that 144 minus 55 minus was the payable 6 minus 6. Okay, so this would be our subtotal, and this will be our sum of this. What I can do is that I'll just bring it over here. So this is cash from operations, right? So this is this figure plus this figure, 71. And then after that, tax, right? So let's do interest first. Interest paid. So how much interest did we pay? So our interest payment was, so finance cost being 8 million, right? So 8 minus something else. So since there has been a incurred cost of 2 million, so we need to reduce that, okay? Minus 2. So 6 will be removed, so that means minus 8 plus 2, okay? Minus 6. And then tax paid. In case of tax, we will need to do a working out. Number 4, the calculation of tax. Hold it, use my sample, Control C, V. Okay, so what's our tax? So our tax is, two figures, okay? Always add what's our beginning tax. So deferred tax being 41 and then current tax payable being 30, right? That's our opening. So 41 plus 30, right? And then have there been any? So first thing first, let's not forget deferred tax. Let's bring that figure from here. Deferred tax, remember that increases our tax liability, right? And then after that, our closing value, right? So closing, let's not go for that immediately. So let's figure out something more. So what's our tax charge for the year? Tax expense 11, right? So 11 x for the year 11, 11. There is one more tax. So what I'll do is that is 11 plus 1 as well, okay? Because see this figure over here, there is a tax liability on OCI as well, okay? So since this will be this figure, and then our closing figure will be something else, and then this will be this. No, it will be plus minus. So what's our closing figure will be? Adding two things up. So 33 and then 32. 32 plus 33. Is our closing really that much? No, let's figure it out one more time. Let's look at it properly. So 32 plus 33, and then remember the deferred tax, that's not included in that figure, in the closing figure. So it's not included in this figure, right? Excluding deferred tax. So that means that has not been added, right? Plus 3, really complicated. So 18, right, is equals to minus 18. Should be our cash from operations. Yes, from operating activities. Let's check the answer as well. No, I made a mistake somewhere. Okay, first over here, I made a mistake over here. So that is cash flow from operating activities. Let's create cash flow from financing activities. Financing activities, right? So bold it. First thing first, purchase or sale of PPE. What has happened with that? So okay, so not investment. So no need to create that. So financing, anything which changes the scope of equity. Okay, so let's look at that section. So deferred long-term borrowing 7167, 7167. So 7167, right? So 7167. So 67 minus 71. Repayment of long-term borrowing. That's out of the way, and then after that, so any dividends paid, anything of that sort. 5, right? So 5 for the parent. Dividend paid to parent is minus 5, that's a cash outflow, and then dividend paid to NCI, right? So how much dividend did we pay them? 11 minus 11. So this should give us our cash flow from financing activities. Okay, bold plus plus this. Okay, this is basically it, right? So we've already solved that problem. So what we will do is that we will go for the next question. Okay, so since these two are already done, so let's explain this thing. So discuss to the extent to which director's comment is valid, right? So it has said that which method should be used, direct or indirect, right? So directors of Jocatt have commented that indirect method of reporting from operating activities is more useful and informative to users of financial statement than direct method. Okay, so let's